Well, Joe Minarik is with us now to help us read the tea leaves in this Fed report. Joe is the Senior Vice President and Director of Research at the Committee for Economic Development. Good to see you again.
Good to be here.
So, Joe, any surprises in the Fed minutes given the ongoing uncertainty surrounding the pandemic?
Not really, Rochelle. The Fed is pedal to the metal, as your report just indicated. Interest rates are as low as they can go. The Fed has resisted the idea of negative interest rates, and what evidence we have suggests that the power of negative interest rates relative to zero is not necessarily all that great. So the Fed is trying to convey to the markets that it recognizes the weakness in the economy, that it will hold interest rates down for the foreseeable future, and will not let rates go up until it is clear that we have escaped this downturn. So they've done pretty much what they can do, and they will be looking for additional tools, but the possibilities are limited.
And it seems they're also looking for additional help. We saw that there were also multiple mentions of a consensus on the need for more fiscal help from Congress. What sort of help would they be looking for, and how likely are they to get it?
Well, as you know, Rochelle, we have allowed the additional federal unemployment insurance benefits, the supplement to the regular state benefits, to expire. There are still some federal tools in use, but the big gun there is now silent. What the Federal Reserve would like to do, they make clear that they can lend money, but can't spend money. They have noted with some frequency that for many of the economic entities that are hurting, additional lending, which means that those entities would be taking on liabilities, is not necessarily going to be helpful. So they've been trying to send a signal to the fiscal authorities, the Congress and the White House, that they need to take action. And allowing the unemployment benefits to expire has not been a good signal to the economy.
And we also saw that Fed officials talked about outcome-based forward guidance, or using specific inflation and unemployment targets before raising rates. What does that tell us about how the Fed is approaching its policy decisions right now?
They're trying to send clear signals that recognize the weakness in the economy and that they have to hold rates low. So what they're trying to say is, we're going to wait until we see a certain measure of inflation or a certain amount of reduction in unemployment before we would consider raising rates. Now, that may be helpful. It, of course, means that once you have set that kind of an indicator, you're something captive to it, and you could have strange circumstances in the future that would require you to take that indicator and change a measure that you had used. So it's an ambiguous kind of a tool. At this point, Chairman Powell has just been very clear. I think at the last press conference he held, at one point he said, we're not thinking about raising interest rates, which is trying to send that signal.
Now, we did see that officials said the persistent drag on growth could also pose risks to the financial system. What could that look like, and how far away are we from that happening?
Well, at this point, we've got a number of individuals who owe rent to their landlords, where their landlords have mortgages on the property. The renters have lost their jobs. They can't pay rent, which means that the landlords can't service their mortgages. So that's a threat to the financial institutions that have made those loans. That applies to individual renters. It also applies to business renters. And the fact that a number of retail establishments, like restaurants, for example, have been hit very badly by this economic downturn is an indicator of the extent to which you could have a lineup of dominoes beginning to fall as individual or business A can't meet its responsibility to B, which means that B can't make the payment to C, and so on and so forth. And that could hit financial institutions as those dominoes begin to fall. And that's what the Fed is concerned about.
And just quickly, Joe, as we're just a few months away from November elections and in the middle of a pandemic, can we expect any significant fiscal or economic policy changes between now and then?
I think there's a very good chance that once the Congress gets back in the beginning of September, that Republicans and Democrats will look very serious at the possibility of a deal, a compromise, so that the legislation where they stalled on their negotiations a couple of weeks ago could back and a compromise could be struck, particularly for members of Congress looking forward to the elections in November, as well as to the president. Uh, Being responsive to the pain that's out there could be very important from a political standpoint.